Welcome to MarketPeeker. Today, we're talking about a powerful tool in Forex trading, leverage. Want to trade big with a small account? That's exactly what leverage allows. But there's a catch. Let's break it down in just a few minutes. Leverage is like a boost from your broker, letting you control a larger position in the market than your account balance would normally allow. For example, with 101 leverage, you can control $100,000 with just $1,000. Sounds great, right? But remember, what can amplify your profits can also magnify your losses. Say you're trading EUR/USD with $1,000 and 101 leverage, meaning you're controlling $100,000. A 1% move in your favor, that's $1,000 profit. But a 1% move against you, that's a $1,000 loss. Leverage works like a double-edged sword, and it's crucial to understand both sides before jumping in. To use leverage wisely, always have a risk management plan. Some traders stick to low leverage ratios or set strict stop losses, allowing them to take advantage of leverage without risking their whole account. When you use leverage, you're also required to keep a margin, a small deposit with your broker that covers potential losses. If your account balance dips too low, your broker might make a margin call to top up funds, or even close your position to prevent further losses. So, stay on top of your account balance.